The 3 rules that you must know when you're reading the markets like a pro of what's likely to occur next. The secrets that no one tells you with Elliott Waves. I'm going to share them with you today because with crypto, Elliott Wave applies so well because it's all based on fear and greed, and the psychology, the FOMO, the FUD is real because buying and selling behavior is really kind of driven by human emotions. If you like today's video, like, subscribe, hit the bell notification. If you don't know me by now, my name is Jiggy. I'm the award-winning author of The Extraordinary New Venture Capital Opportunity, How to Invest Like a Pro. Been featured in the best-selling book, High Probability Trading Strategies, back in 2008, where I used to focus on currencies only, but now exclusive on crypto. So let's dive straight in. Right, we're going to do some theory. We're in teaching mode right now. Right, so the market's moving a 5-way sequence. You're getting used to that now, right? And an ABC correction. Right, we're used to that. But the rules, rule number 1, wave 2 cannot retrace past the beginning of wave 1. Basically, it means the market, when it moves up, the first move to the upside, the downside movement cannot go past and should not go past the beginning of wave 1. Wave 2 cannot retrace past the beginning of wave 1. If it does, it invalidates the wave count, and we need to reevaluate the market. We need to reevaluate what we're looking at, right? Second rule, rule number 2, wave 3 cannot be the shortest of wave 1, 3, and 5. So when we're looking at this, there's certain buying and selling behavior. And what Ralph Nelson Elliott figured out was wave 3 can never be the shortest. It can be the second shortest, but it can never be the shortest. And if it turns out to be the shortest, it's probably an invalidated wave count. We need to reevaluate the market. A bit more advanced than what I'm coming with you here, but it's also powerful, very, very important. And wave 4, this one's important, cannot trade into the wave range of wave 1. Now, sometimes it might do by a millimeter, by a few pence or something like that. Then you have to kind of make a judgment call. But more often than not, if this wave 4 goes really deep into this wave 1 zone, like it really goes deep into it, it's likely that it's not a wave 4. We have to reevaluate the whole thing because it breaks the pattern. It breaks the human psychology behavior. And we want to go with the probability of what's likely to occur next. So last but not least, if any of these rules are violated, the wave structure as labeled is incorrect and must be reevaluated, right? So I'm going to show you something with Bitcoin in a second, where I'm going to take a really macro view because we want to have a thesis, a hypothesis of what's likely to occur next, what's your thinking, and then what's the probability of that occurring. So let's just jump into a live chart now. I'm going to go into Bitcoin. Oh, we can use Solana as well, actually. Let's use Solana. Because we used this in a previous lesson, right? And what I'm going to show you with Solana is a couple of things. One, because I use this all the time, right? We believe this to be a wave 2. If we believe this to be a wave 2, let's just draw this out. A wave 2, right? We know it shouldn't pass the beginning of wave 1, which is down here, which it didn't, right? So we go, yep, looks good. Then we go, wave 3 cannot be the shortest out of the 3 waves. So now as the wave structure unfolds, like it did a beautiful move to the upside, right? And we did a video down here on Solana, right down here. Like this is the video that we did on Solana, which was actually down here. We projected this in advance, but we was using a lot of these rules, right? This is what I'm showing you. I'm showing you all my secrets. Bang, right? So wave 3 cannot be the shortest. So clearly, without a shadow of a doubt, it's longer than wave 1, right? So that's fine. Bang. And then we go wave 5 or wave 4. Let's do the wave 4 rule. Wave 4 rule is it cannot trade into the range of wave 1, right? So this is the range of wave 1. And then wave 4, which is this one here, should not trade into this range. So we know this should be the absolute floor if the price was to go down. It shouldn't go beyond this. If it did go beyond this, it would invalidate the wave count. We need to reevaluate. It only went down to this range, and then it continued to a higher high. And then last but not least was, what was the other one? Let's just jump back into the lesson. I think it was this one here. We said, cannot retrace. Yeah, oh, we covered all three. Brilliant. So now let's just do the same for Bitcoin. We're looking at a macro picture, right? So again, we had this amazing 2017 bull run. Wave 2 down here should not go into the range past the beginning of wave 1, which is down here. It didn't. It was a deep retracement. It was like really, really deep, but it didn't go past that. So that's fine. Wave 3 cannot be the shortest. Well, wave 3, like look at that, bang, it's way bigger than wave 1, right? So we go, yep, that follows. And wave 4, now we don't know this yet, but wave 4 should not trade into the range of wave one. So if this is a wave one on a macro picture, right? Well, then wave four, which is we're considering this to be wave four, and if I can get this up, bump up down here, should not go into this range. What was this range for Bitcoin? Well, it's around $20,000, right? So it should not trade. If it does, that breaks the wave count, breaks the psychology, breaks the expansion and contraction basis of all markets. So we're anticipating it should be a maximum of down here, right? So this was the theory and the practical. They're the three rules. What are they? Wave two should not go beyond the beginning of wave one. Wave three cannot be the shortest of wave one, three, and five. Wave one, 3, and 5. And wave 4 should not trade into the range of wave 1. Wave 4 should not trade in the range of wave 1. So these are key fundamental rules of buying and selling. Sometimes when you're looking at price, it's confusing, especially if you're new to the game and you're looking at why is it going up? Why is it going down? Why did it explode and now it's coming back down? Even though the project has advanced, the project has got better, the sales have gone up, the number of wallets or members has gone up. Why is it coming down? Well, it's just human psychology, profit taking, behavior, pessimism, optimism, euphoria, fear, uncertainty, and doubt, fear of missing out. All of that is combined, and we simplify it by having Elliott waves in our corner. And this is where I'm showing you how you can train yourself. So when you're looking at the markets, because crypto is here to stay, blockchain is here to stay. This new source of value that's been created where things didn't have value before, where it's an NFT, piece of digital art that has some type of utility, some type of use case, but the value goes up and down of the underlying token. We can apply this, and when it's relevant, we will see, okay, it's getting overvalued right now because it's a wave 3 or wave 5, and people are going to start selling. So you want to sell beforehand. And there's other times where it's like, actually, it's a wave 2 forming. I'm not concerned. Like you'll see some tokens right now. There's been a big pullback. In my mind, I'm going, Chicago's a wave 2. It hasn't gone beyond the beginning of wave 1, and there's a wave 2. It's in the range of 50 to 78.6%. I go, that's natural, that's normal, it's healthy. When the optimism comes back into the market, it's probably going to explode to a 1.618 or to a 2.618 like Solana did. So now, all of a sudden, this emotion gets pushed to the sidelines, and this objectivity, non-emotional behavior and decision making comes to the forefront. And that's when you will shine as a superstar. So let's read a quote. Yes, here we go. There's a little game for you, I guess. Aristotle says it nicely. Those that know, do. Those that understand, teach. Right? So know and teach. So those that understand, in other words, see if you can explain some of these Elliott Wave principles to another person that's not really in the game, just to further understand your own knowledge. Because if you start getting familiar with these wave 1s and wave 2s and wave 3s and wave 4s and wave 5s, when you're looking at price action, you can go, Decentraland's recently just gone, boop. Is that a good time to buy? No, I like to buy at the end of a wave 2 as opposed to the end of a wave 3, right? When it's going down, when everyone's panicking, you can kind of have this objectivity and go, nope, just a healthy correction before the next sprint. It's normal, it's healthy. We saw it with Solana, we've seen it with Bitcoin, and we see it with a lot of the micro caps, mid caps, and even the large caps. So there you have it. So if you like today's video, like, subscribe, hit the bell notification. Take my free Elliott Wave and Fibonacci masterclass. It's in the link below. I've broken down a lot more in digestible, easy bite-sized chunks in my best effort on keeping it in layman's terms. So I will see you soon. What we're covering next? We're going to cover some more Elliott Waves. I'm just bashing out these lessons. Whilst we're going through this correction, you need to upskill yourself because most of the money, most of the profits are made in the last 20% of the bull run. We're moving into that last 20% very, very fast. And we can see some parabolic moves. And people are terrible at taking profits, terrible at reading the markets, over emotional. That's natural because we're unconscious beings, but we need to have a business plan, a trade plan, so we can execute and see things that others are not seeing so you can win, increase your financial health, so you can be happy with yourself, not in a year's time going, man, I was this much up and now I'm back down. No, we don't want that. We want to win, win, win. All right, see you soon.